There are two prices for silver right now. One exists on a screen, a number generated by contracts that reference metal nobody plans to deliver. The other exists in the real world, the price a dealer charges when you walk in and ask to hold an ounce in your hand. Those two numbers should be identical. They are not. They are diverging at the fastest rate in modern history. And what happens in the next 72 hours will determine which price survives and which one dies. The number on your screen says silver costs roughly $75 an ounce. Call a dealer, visit APMEX, try JM Bullion, ask for American Silver Eagles. You will be quoted $95, maybe $100. That is a 30 to 40% gap between the theoretical price and the real one. In a healthy market, that gap does not exist. In a dying market, it is the first crack in the foundation before the entire structure comes down. Tomorrow is Wednesday. The Federal Reserve releases its FOMC minutes. Options markets are coiled around strike prices like loaded springs. And beneath it all, the vaults that underpin the entire paper silver market just crossed a threshold that has not been breached in decades. A threshold that, once broken, mathematically guarantees that not every contract holder can receive what they were promised. This is not speculation, this is arithmetic, and the arithmetic is unforgiving. What you are watching unfold is not a correction. It is not a dip. It is the terminal phase of a system that has traded promises in place of metal for so long that the promises now outnumber the metal 4-1. The question is no longer whether the system breaks. The question is whether you understand what is happening before it does. Today, Tuesday, February 17th, silver dropped. Spot traded between $74 and $75. The financial press blamed a surging dollar. They pointed to Kevin Walsh's nomination as the next Fed chair and called it a hawkish signal. Higher rates, stronger greenback, weaker metals, a clean, simple story, and a convenient one, because it obscures what actually happened on the trading floor today. What happened was a coordinated liquidation. While retail traders watched red candles and hit the sell button, institutional desks were absorbing millions of ounces in paper contracts at discount prices. The same entities that built short positions near $120 were covering at $74. They were not panicking, they were harvesting. Today's crash was not a market event. It was a wealth extraction, timed with surgical precision for what comes tomorrow. To understand why Wednesday changes everything, you need to see what is inside the vaults. And what is inside the vaults will keep you awake tonight. For decades, the global silver market has operated on a simple agreement. You buy a contract, and somewhere in a vault, a corresponding amount of metal exists to back that contract if you ever demand delivery. The exchange that manages the system is the COMEX, the commodity exchange, and its credibility rests entirely on one category of metal, registered inventory. Registered silver is metal that has been inspected, certified, and designated as available for delivery. It is the only silver that can settle a futures contract. Everything else in the vault, the eligible category, belongs to private holders, ETFs, and banks who have parked their metal there for storage. Eligible silver is not for sale. It is not available. It just happens to be in the same building. On February 11th, 2026, registered silver inventories on the COMEX fell to 98.1 million ounces. That number deserves to sit with you for a moment. For as long as modern commodity markets have existed, 100 million ounces was considered the floor, the minimum buffer required to maintain confidence that the delivery mechanism works. We are now below that floor. We are operating without a safety net. Now look at the other side of the equation. March is the largest delivery month of the year. The current open interest for March silver contracts represents over 400 million ounces, 400 million in claims, 98 million in deliverable metal. That is a ratio that does not resolve peacefully. If this framework is clicking for you, if the gap between what is promised and what exists is starting to feel like a story worth understanding, subscribe and hit like, because the next layer of this makes the inventory problem look simple. The COMEX has survived imbalances before by relying on a pressure valve. Most contract holders never actually demand delivery. They roll their positions forward or settle in cash. The exchange counts on this behavior the way a bank counts on depositors never withdrawing all at once. But what happens when the incentives change? What happens when the real-world price of silver exceeds the paper price by such a margin that standing for delivery becomes the rational choice? The answer is what bankers call a run, and it is already beginning. Look east. The Shanghai Precious Metals Exchange is pricing silver at approximately $87.50, a $12 premium over New York, roughly 17% higher. In theory, arbitrage traders should close that gap instantly. Buy cheap in New York, ship to Shanghai, pocket the difference. But effective January 1st, 2026, China implemented export licensing restrictions that limit silver exports to 44 state-approved firms, each requiring $30 million credit lines. Metal flows in, metal does not flow out. Shanghai has become a gravity well, pulling physical silver out of Western vaults at a pace the system was never designed to sustain. The Western paper price is not discovering value. It is performing a memory, echoing a market that no longer reflects physical reality. And that performance is about to meet its audience. Everything described so far, the inventory crisis, the Shanghai vacuum, the 4-to-1 delivery imbalance, represents the structural condition of the market. It tells you the building is compromised. What happens tomorrow tells you when the earthquake hits. Wednesday, the Federal Reserve publishes its FOMC minutes. These minutes will reveal the internal temperature of the rate debate, whether officials are leaning toward holding, hiking, or eventually cutting. The market is pricing in continued hawkishness, which has propped up the dollar and suppressed metals. But there is a ghost in the data that the Fed itself has not fully reckoned with. The Bureau of Labor Statistics recently revised its 2025 employment figures. The revision erased 1.1 million jobs from the record. Jobs that were reported, celebrated, used to justify rate hikes and project economic strength. They never existed. The strong labor market that underpinned the Fed's tightening cycle was, in part, a statistical phantom. If the FOMC minutes contain even a flicker of acknowledgement, any language suggesting the economic foundation is softer than the headline data implied, the dollar weakens. And when the dollar weakens, the mechanical trap that has been building in the options market detonates. Here's the mechanism. When silver crashed on February 12th, major institutional players did not simply cover their short positions. They simultaneously accumulated massive call option positions. The $120 strike became a wall of concentrated bets. Market makers who sold those calls are now exposed. If silver rises, they must buy futures contracts to hedge, a process called delta hedging. Their buying pushes the price higher. The higher price forces more hedging. More hedging drives more buying. This is a gamma squeeze, a self-reinforcing loop where the mechanics of risk management become the engine of price acceleration. The trigger level is $80. If silver crosses 80 with volume, the hedging cascade activates. Technical models project a wave target between $92 and $94, a 25% surge from current levels, potentially within days. This is not a fundamental repricing. It is a mechanical event, like a spring that has been compressed past its tolerance, snapping back with force that exceeds the original pressure. And this is precisely why today's sell-off was engineered. Flush the leveraged retail positions at 74, wipe the stops, clear the path. Then ride the reversal without the passengers who were shaken out at the bottom. The Tuesday crash and the Wednesday rally are not separate events. They are two halves of the same trade, a transfer designed to move wealth from the impatient to the positioned. The technical structure confirms it. The $71 to $74 zone represents the 200-day moving average and the previous breakout level. Today's price action formed a triple bottom on the hourly chart, the classical reversal signature. The line in the sand is drawn. If it holds, the energy stored in the options chain releases upward. If it breaks the next support, sits near 65, but given the physical deficit, any price at that level becomes less a collapse and more an invitation, the kind of discount that does not survive contact with reality for long. Strip away the charts, strip away the options chains and the Fed minutes and the gamma triggers. Underneath all of it sits a truth that the financial system has spent years avoiding. The world is consuming silver faster than it can replace it, and the industries doing the consuming will pay any price to continue. Consider what keeps an Nvidia Blackwell chip from destroying itself. At the densities required for advanced AI computation, heat becomes an existential problem. Silver possesses the highest thermal conductivity of any element, 429 watts per meter Kelvin. Nothing else comes close. It is applied in microscopic layers as a thermal interface material, dissipating heat that would otherwise melt the processor. When that chip reaches end of life, the silver is functionally gone, too dispersed, too embedded, too costly to recover. It is consumed, deleted from the global supply with every server rack that powers every AI query on the planet. OpenAI alone is planning data center capacity measured in tens of gigawatts. Every watt requires infrastructure. Every piece of that infrastructure requires silver. This is not speculative demand. It is engineering necessity. Now add the dimension no one in the financial press is discussing: military consumption. Reports indicate that Israel has integrated over 400 tons of silver into its defense infrastructure. Electromagnetic pulse shielding, hardened communications, and critical system protection. But the real draw is hypersonic weapons development. At Mach 5, atmospheric friction generates temperatures that destroy conventional electronics. Silver-based semiconductors and guidance systems are among the only materials that survive. A single Tomahawk cruise missile contains roughly 500 ounces of silver. When it detonates, that silver vaporizes. The Pentagon is purchasing from the same shrinking pool that supplies Apple, Tesla, and the global solar industry. And the Pentagon does not negotiate on price. Here's the question that sits at the center of everything in this video, and it is the question that mainstream analysis refuses to ask. What happens to a price discovery mechanism built on abundant supply when the supply enters irreversible decline and the demand becomes non-negotiable? Think about that. If the industries that need silver will pay $200, $300, $500 because the alternative is a $30,000 chip that does not work or a missile that cannot fly, then what is the paper price actually measuring? Drop your answer in the comments. I read everyone, and the sharpest analysis on this channel consistently comes from you. February 27th is first notice day for March delivery. In 10 days, contract holders must declare whether they want cash or metal. The COMEX holds 98 million ounces. The claims exceed 400 million. If even a quarter of holders stand for delivery, the math fails. The exchange either delivers metal it does not have, or it defaults. This is not theoretical. The London Metal Exchange faced a similar crisis in nickel in 2022. They canceled trades. They changed the rules mid-game. They protected the short sellers. But there is a difference between nickel and silver. You cannot print silver. You cannot legislate it into existence. Physics does not negotiate. So here's where we stand. The registered vaults hold less deliverable silver than at any point in recent memory. The largest delivery month of the year is 10 days away with a 4-to-1 claim-to-metal ratio. Shanghai is pricing silver 17% above New York, and the arbitrage channel has been sealed shut. Industrial consumption, from AI chips to hypersonic weapons, is accelerating on a curve that treats price as irrelevant. The labor data that justified the Fed's rate stance has been retroactively gutted by over 1 million phantom jobs, and the options market is coiled around a gamma trigger at $80 that could produce a 25% move in days. Each of these factors alone would be significant. Together, they describe a system approaching a phase transition, the moment when a market stops behaving like a market and starts behaving like a crisis. What does that mean for you, specifically? If you hold paper claims, shares in silver ETFs, unallocated accounts at bullion banks, futures contracts you never intend to take delivery on, you hold a promise, and promises are only as reliable as the institution making them. If the COMEX enters force majeure, paper claims settle in cash at the last quoted price. You receive dollars. You miss the repricing. The entire point of owning silver, protection against the system's failure, evaporates at the exact moment you need it most. If you hold physical metal, you hold the asset itself. No counterparty, no intermediary, no exchange that can rewrite the rules after the game has started. The ounce in your hand does not care about COMEX inventories or FOMC minutes or gamma squeezes. It simply is what it is, and in a world where claims outnumber reality 4-to-1, being real is the ultimate advantage. Tomorrow will be volatile. The minutes drop. The dollar reacts. The options chain responds. There will be noise. Loss anchors on financial television explaining why metals are finished. Algorithmic selling designed to trigger one last wave of panic. Ignore the performance. Watch the $80 level. Watch the inventory reports. Watch the Shanghai spread. The signal is in the data, not the commentary. At the top of this video, I told you there are 2 prices for silver. One on a screen, one in the real world. For years, the screen price has dominated. It set the narrative, it dictated sentiment, it told you what silver was worth, but a screen price only holds authority as long as the system behind it can deliver what it promises. When the promises exceed the metal by a factor of 4, authority transfers. It moves from the abstract to the physical, from the contract to the commodity, from the institution to the individual holding the asset. That transfer is not coming. It is here. The only question left is whether you recognized it before the price did.